Okay, now you
Good
can.
morning to all the brokers on the line and to the brokers that know me personally. Welcome to our first Tuesday session for the year 2023. My name is Ferguson, and on the line we also have Tove and Mamweti. We have Dr. Azar in the building this morning to just talk to us on all things seemingly gloomy, but we're hoping that there will be some really good insights that come out of this.
Absolutely. Welcome, Dr. Azar. And as the first Tuesday of the year, we're really pleased to have your really pertinent insights. I'm sure this is something that is a daily, hourly conversation within our country. So to have an expert on the line to just give us a bit more of a scope of what's happening, we really appreciate what you prepared for us today.
Thank you very much. Thank you. Cool. Would you like me to proceed?
Yes, please. You can take it away.
Okay. Okay, let me get my screen on. Right, I hope you can all see this.
Yes, we can.
You can. Right. I've been asked to do, outlook for 2023 and beyond, and the risks that we're likely to confront. And Happy New Year to everyone. I wish I could say it in a more joyful, well, I suppose I'm saying it in a joyful presentation, but obviously there are some major headwinds that we've got to face. Let me just start off with looking at the recent history of the South African economy. And what you see quite clearly here is this is our GDP growth rate gradually coming down, recession already there in 2019 when the economy was already weakening when COVID-19 hit us, strict lockdown, and there was a crash in economic activity of almost 20%. And then, of course, lockdown ended and there was a countervailing dramatic recovery off a very low base, remember, year-on-year growth. And since then, we've slid back to an environment of around 2% growth. There was a pickup in the third quarter of last year, which is the latest official figure that we've got, simply because it was being compared against the third quarter of 2021, which had been characterized by major unrest in the country and looting. But I think the more important picture is this one here, which shows, in fact, if you were to take it back even further beyond 2008, you would see that there was a very close correlation between the performance of the South African economy in red and the world economy in blue. And suddenly from around 2012, 2013 onwards, the two started diverging. The world economy carried on growing at a nice pace. The South African economy's growth rate began slowing down. And I believe that this is no coincidence. What happened was that in 2009, Jacob Zuma took over as president of the country and presided over a project of state capture. Initially, we didn't see the negative effects, but within a few years, you started really the impact of a transfer of resources away from the country at large to the pockets of a handful of individuals started reflecting in the real figures. And ever since then, the economy has been underperforming. This is not to say that that is the single and only structural impediment. I'm going to go through them in a moment, but it was a very, very important turning point in the recent history of the South African economy. With the result that now, if you look at the latest IMF forecasts for different leading economies of the world for this year and next year, you see South Africa right down here near the bottom. Whereas, as I say, in previous years, we were really very much in line with the average of the world as a whole. Sub-Saharan Africa is looking better than is looking quite a lot better than South Africa at the moment, with the leading countries obviously being India and China leading the way. If you look at the breakdown of the performance of the economy by sector, what you notice is that the path of economic activity has not been uniform. The one sector that stands out with great success has been agriculture. And last year, the figures came out last week, we had record tractor sales, for example. And that tells you what can be done. I mean, the number of farmers has diminished. In fact, the number of workers has diminished in agriculture, but the industry has become so much more competitive and has assumed and embraced technology to a far greater extent than some of the other sectors. And at the opposite end, you can see the laggard has been what is known as construction, which includes residential and non-residential building, as well as civil engineering. It has been a dog. Activity is down about 30% compared with where it was 5 years ago. And it speaks to the lack of infrastructural investment that has been taking place in the economy. The rest of the crowd are kind of in between there. You'll be glad to see that the financial services sector is the second best performing sector within the economy, followed there by personal services. You're involved in transport, well, it's actually one of the weaker ones. But generally speaking, there's been a trend towards more consumption and less investment. And to some extent, this is reflected in this comparison of where we stand right now. The red line is GDP, and you can see we have now got back more or less to where we were prior to the onset of COVID-19 and the massive crash that took place soon after that. No, in fact, that was COVID-19. We had already started softening, so we're above COVID-19 there. But employment levels are still around 4 or 5% below where they were at the time of the outbreak of COVID-19, which implies that the economy has become more capital intensive or less employment intensive. And worst of all, capital investment itself is down around 11, 12% compared with where it was pre-COVID, illustrating the lack of infrastructural investment, which we see on a daily basis in terms of, firstly, the lack of electricity, the decline in our transport and rail networks, the number of potholes around, generally the water problems, water reticulation problems, and service delivery more generally. And yet the economy itself has managed to grow a lot better despite that service delivery. And that speaks to one area that I don't think is fully recognized, and that is the manner in which ordinary private businessmen are still keeping the show on the road, notwithstanding all the headwinds that they are facing. But on a negative side, you can see how the level of unemployment has gradually accelerated, especially from around 2015 through to 2019. Then came COVID, the massive destruction of jobs, and then a huge increase in unemployment after that, as people have been struggling to find jobs again post-COVID, as the business sector has adapted to the ravages of lockdown and has become ever more capital intensive and adopted ever more investment in IT to bypass labor, which is quite a sad story for a country which has an abundance of unskilled labor. But I mentioned the corruption and state capture that started emerging a decade ago, and that is undoubtedly the biggest structural impediment. There are various estimates about how much of the economy has really resources have been used up in state capture. And I think a fair number is around 1.5 trillion rand, when the overall GDP is now 6.3 trillion rand. About a quarter of the economy has been decimated through corruption. And that a lot of that has occurred through state-owned enterprises, which have been used as the vehicles through which a lot of that corruption has been enacted. And of course, that has led to a major impediment to our economic growth in the form of insufficient electricity and the increased intensity of load shedding. That in turn has contributed towards a reluctance of businesses to invest in the economy, and yet people have carried on spending. And it's an unfortunate situation that links to growing inequality in the economy. Basically, you've got about 15% of the population that consumes 85% of whatever is spent in the economy, and 85% of the population consumes only 15%. But it does mean that a lot of big businesses and small business, if they concentrate on the middle and upper income groups, they haven't been doing too badly. Where there's been absolute decimation is the poor have just got poorer relative to the middle and upper income groups. And fortunately, you're linked more closely to the latter, and therefore probably in your businesses have not felt the impact economy. There's also a lot of economic policy uncertainty arising from the factional divides within the ruling party, where different people, different politicians speak with different voices on different things. And that has been a source also of impediment to investment. There has been a rather pernicious antagonism on the part of many politicians within the ruling party, not all, but many, many drawn from the so-called RET faction, who basically see anything to do with the private sector as bad news, and who have gone out of their way to overregulate and introduce bureaucratic impediments to private sector doing the job. And yet we recognize more and more with every day that passes that it's the public sector that is really holding back progress in this economy. And yet there is still much of the political environment wants to see the government playing a bigger, not a smaller role in the economy. Despite the fact that there is an acute lack of capacity within government to implement projects. And a lot of this has to do with the policy of cadre deployment, which has seen people being appointed to very important positions without the relevant skills or inclination, simply because of their contacts. Linked to this is the decline in educational outcomes. Here too, we see huge levels of inequality between the haves and the have-nots. Those who've been fortunate enough to go to private schools or Model C schools and have had excellent education, and thank goodness for them, because they are still holding the backbone of the economy at large, but they only account for about 15% of all school children that come out. The opposite, the 85% of school kids just receive very, very poor education. There was a statistic that I saw over the weekend. There were, out of 1.07 million students that began school 12 years ago, in 2022, 33,000 managed to get 60% pass rate for mathematics in matric. So that is around 3% of those who started school ended up doing well enough in their maths in matric to be able to command a lot of the a job that is in great need from the economy. And then the final problem that we have had is the high cost of interconnectedness. Here, fortunately, we have made some progress in terms of the auction of broadband spectrum, and we have seen the cost of connectivity actually declining, but it's still quite high and is still a big impediment for the large majority of the population to actually get onto the bandwagon. Now, we move on to the political front, and here, of course, we've had a lot of movement in the last couple of months, starting with the re-election of Cyril Ramaphosa as president of the ANC at the NASREC December National Elective Conference. A lot of people were quite encouraged by the fact that he won, and he's the leader of the move to try and reform this economy, to try and put it back onto higher growth path. He's at the leadership of the move to fight corruption. And people were encouraged that 5 out of the top 7 of the ANC are basically strong supporters of Cyril Ramaphosa. Nomvula Mokonyane being the exception, and we don't know where Paul Mashatile sits within that. And then, you know, Ramaphosa has committed himself in his 8th of January ANC 111th birthday celebration, the renewal of the ANC and the commitment to fight corruption, end factional battles, embark upon massive infrastructural investment and professionalization of the public service. And one welcomes those statements until one saw the election of the broader National Executive Committee of the ANC and saw the re-election and at fairly a high level of ranking of some of the what many would call bad eggs within the ruling party, who have been accused of corrupt activities or other misdemeanors. And so one questions whether one can really see the renewal that is needed to embark upon the structural changes that need to be seen. There have been passionate calls on the part of many within the ANC for SOEs to remain in government hands and to persist and be the cornerstone of the economy. And yet all we see every day is the deterioration in those organizations. Then, of course, we've also seen the phasing out of some of the lack of support for some of the old guard, such as Dlamini Zuma, Lindiwe Sisulu, Pravin Gordhan, Naledi Pandor, Ibrahim Patel, Bladen Zamandi, Tulas Nayesi, all members of the top echelon who were not re-elected into the NEC. And that suggests that Cyril Ramaphosa is likely to, well, will have to embark upon a major cabinet reshuffle. And there are rumors which will happen before. Well, we don't know whether it'll be before or after the Sonar speech later this week. But the question I ask is there enough new blood within the organization to ensure renewal? Infighting is embedded within the organization. We're seeing political murders almost on a daily basis. And that means that the likelihood that improved service delivery will remain lacking is quite high. And if that is the case, then by next year, there's a very good chance that the ANC will lose its national majority in parliament. That opens up a fork in the road looking into the future. Is that a positive or is it a negative? From a positive point of view, it could be argued that you'll see more competition between political parties to prove themselves through efficiencies and to work together to try and ensure success in the economy, and that could see a reversal of the debilitating trends that we've seen over the past decade. Cynics, on the other hand, will say, look at what's happening in Joburg and Kuruleni and Nelson Mandela Bay. The coalition governments are a recipe for total chaos and mayhem. I leave it to you to choose. I'd like to think, though, that there is potential for a turning point from next year onwards for the better. One of the important issues and opportunities that exists is to try and lift capital investment in the economy, which is woefully low. For emerging markets as a whole, the average is 30% of GDP. We're at 14% of GDP. The good news is that there has been a marginal improvement in the last year or two. And that marginal improvement has been driven first and foremost by the private sector. So there has been increased private sector investment, albeit marginal, but I think a lot of it is concentrated on renewable energy projects, which are actually going to help fight the energy insecurity in the economy. But you can see the dismal, woeful state of state-owned enterprises, the black line, where one of the sources of the declining investment is that SOEs just don't have the money anymore to invest. And we're seeing this in all sorts of spheres, most notably, of course, electricity, water, and transport. From a sectoral point of view, the construction sector has felt the brunt of this, whereas investment in machinery and equipment has performed a lot better. And a lot of that has to do with investment in information technology to try and reduce dependence on the state in a lot of these activities. Now we come to the load shedding. No question, this is the biggest blight on our short-term economic future, hopefully not the longer-term economic future. The Reserve Bank itself, in its latest Monetary Policy Committee forum, suggested that they had downgraded, their models showed that they should revise downwards the GDP growth of the economy by 2% per annum on account of the intensification of load shedding that we've seen. And the situation has been aggravated by the shortage of funding to buy diesel, because one way of reducing the level of load shedding is to start getting those open cycle diesel driven gas turbines moving, and they can produce 2,000 megawatts of electricity, which is equivalent to 2 stages of load shedding, reducing them by 2 stages of load shedding. But on the other side, we've got some permanent, almost semi-permanent outages in the form of Koeberg Unit 1, which is out of action for at least 6 months. They say 6 months. Experts say it could be years, which is reducing availability of electricity by 1,000 megawatts. Then Kusile, the same thing. One of its units is to be completely redone, and that'll be out of action for another year or two. Another almost 1,000 megawatts. On the positive side, I was asked by Toby just before, what do we do to escape load shedding? Well, more and more people are going off the grid, taking solar, wind, or generators to try and reduce their dependence. And fortunately, the economy seems to have been able to adapt to some extent to the increased incidence of load shedding. But you know, when you get to stage 6, we've seen knock-on effects that are debilitating. So the common thread at the moment is that we can live not too badly with stage 2 to 4, but once we get to stage 6, it becomes really, really serious problem. And the other problem is, of course, that who is it who can afford to reduce their dependence on electricity? It's the wealthiest sections of society, bigger corporations, small businesses. It's just too expensive for them. And so this load shedding is actually a recipe for increased inequality. You can see this graph here that I show how the energy availability factor has just deteriorated to below 50%. In other words, of all the electricity generating capacity that we have right now, we are managing to use less than 50% of it for the first time ever. The objective is to have 75% EAF, and we're down at below 50%. What this actually translates into, if you look at the numbers, is we've got about 46,000 megawatts of electricity capacity. About 5,000 to 6,000 of that is permanently down to do maintenance work. But there have been outages anywhere between 16,000 and 22,000 megawatts from time to time, more recently, due to breakdowns of aging power stations, due to breakdowns because of theft and vandalism and poor management in many instances. So that means that if you add, you know, in the worst case scenario, 6,000 to the 22,000 unplanned outages, out of the 46,000 megawatts available, you're down to only 20,000 or 22,000 that can actually function. And yet the demand for electricity in summer is 27,000 megawatts. Therein lies the shortfall of between 4,000 and 6,000 megawatts at present, which necessitates stage 4 to stage 6 load shedding. What scares the hell out of me is when we come to winter time and the need for heating and so on, the demand for electricity goes up to 33,000 megawatts. Then we're really talking about the potential for stage 8,000 megawatts or even worse load. And that's the situation that is very precarious and the biggest risk to our short-term outlook for the economy. Electricity is not the only big problem. Of course, linked to electricity is potential shortages of water that are geared to it, and that is another major problem. And the third one is, of course, transport. And what we have seen, and these figures show the latest figures of Transnet's volumes, how they've been declining progressively over the last few years. And coal exports have deteriorated badly at a time when coal prices were at near record levels. And according to the Minerals Council this week, they estimate that we've lost around 50 million rands worth of exports, purely on account of the fact that the rail network of transport of Transnet has not been able to transport coal to our harbors, and the harbors themselves have not been able to deliver that. That's the other, aside from electricity, the other huge impediment. We now have a situation where 85% of all freight is transported by roads, and that is also, of course, damaging our roads and creating more and more potholes. And we just have not been pouring in sufficient money to improve our road network. And this has led to a lot of disillusionment, especially in areas where people have become disillusionment with the source of government, such as Gauteng. And we see potholes proliferating here, whereas they don't proliferate to the same extent in the Western Cape. It's almost as if potholes are the litmus test of decent municipal and provincial management. And the result has been, and I mean, this is probably the most effective reflection of what is, of the dynamic that has come to be known as semigration. A lot of South Africans have got disillusioned and gloomy about prospects and wanted to leave the country, but the majority can't afford to. So what are they doing? They're going to where they think, relatively speaking, provincial government is better. And the result has been a huge shift of people to the Western Cape away from the likes of Gauteng. And the best way I was able to find this was in building plans passed. You can see since 2020, the dramatic decline in building plans passed in Gauteng, which is in black, from 46,000 to 29,000 29 million square meters of plans, and on the opposite side, a big pickup in investment in potential building in the Western Cape. Now, there is one scenario that could change the outlook completely for the better. And we've already seen signs. The governor, Ramaphosa himself, seems to have recognized this. And that is infrastructural investment. He already in 2020 spoke about, in his economic recovery and reconstruction program, the potential that had been agreed upon between government and private sector bodies to embark upon 51 projects worth 340 billion rand on housing, roads, sanitation, electricity, obviously, and rail, etc. Then in the medium-term budget policy statement of November 2021, Enoch Godongwana pronounced on a further 55 projects worth 595 billion rand that had been identified. And then last year, every year we have these investment summits held by the government, and Cyril Ramaphosa proudly mentioned that 1.14 trillion rands of capital investment projects had been committed to. Now, this is massive. It's 54% of total annual fixed investment. If any of this were to start being implemented properly, we could see a growth in capital investment of anywhere between 20 and 30% per annum, and economic growth moving back to 5 or 6%, creating hundreds of thousands of new jobs. What's also helping the situation is we've had a commodity price boom. The country has been able to, notwithstanding Transnet, still been able to generate an improved export earnings, and that has also helped to bring in a lot of extra tax revenue with which to fund this. But we are just not seeing this translated into real economic activity. And what a shame, because on the positive side, we have seen the re-establishment of stability and respect for a number of major institutions in the country, such as the National Prosecuting Authority, and on the business side, National Treasury, South African Revenue Services have also, which were decimated by the Zuma administration, have also somehow recaptured some of their kudos in recent years. And of course, the Reserve Bank is all there as a bastion of stability in the economy. So we do have the base from which to really and truly get this economy moving upwards. Instead, what we're seeing is the opposite. This is mining output. Look how it's fallen in the last couple of years. And that is notwithstanding the surge in commodity prices. We've been very fortunate, fall in mining output, but growth in mineral exports, although these are also starting to lose ground as the world economy starts slowing. Manufacturing production, still we're no better than it was in 2010, no better. And in the last few years, a bit of a slide downwards. On the other side, retail sales are up 100% compared with where they were in 2010. And they've managed to gain ground back to above the levels that prevailed pre-COVID. Vehicle sales, an astonishing recovery actually in the last few years. Again, back to levels, pre-COVID levels, unlike manufacturing and mining. So the production side of the economy is being decimated, but the consumption side is still holding up reasonably well. Obviously, the vehicle sales situation is also a little misleading, because if you look at the relationship between sales of premium cars and your entry-level cars, your budget cars, the latter have seen their market share increasing dramatically compared with the former. What's also helping the vehicle industry and the economy as a whole is a resurgence in tourism following COVID. We've seen rental sales sales of cars to motor rental companies improving. There you see foreign tourist arrivals gaining momentum, even without the sponsorship of Tottenham to publicize how good South Africa is as a place to visit. I mean, you know, deal with crime and load shedding first before you go spending billions on promotion. What has also helped, and I think this may be relevant for yourselves, is that people in the last couple of years have started borrowing again. You know, in fact, going back to 2012, there was a massive surge in debt, unsecured debt, saw the collapse of African Bank and a big fallout from that. And then it stabilized. And for many years, South Africans just didn't want to borrow money at all. But with interest rates having come down by 3% following COVID, we suddenly saw from 2021 onwards a resurgence in borrowing that lasted through until the latter part of last year. There's been a little bit of a slowdown again in it at the corporate level, but look at household credit extension. It's picking up nicely all the time and helping to compensate for the erosion of disposable income through higher inflation and higher interest rates. On the positive side, you might get frightened by this increase in proclivity to borrow, but broadly speaking, on reflection, it's relatively minor by historical standards. Look at where household debt was as a percentage of GDP in 2008. And that fell all the way through to 2018, and it's picked up a little. So there's still quite a lot of capacity for people to borrow more. Sorry, I see a hand has been raised. I don't know if there's a question from Nozibele Mlobo. All right, I'll answer it later. If you look at the growth in the number of new accounts in default, consumer accounts in default, taken from TransUnion, it's virtually zero. So, you know, the financial position, a lot is made of the deteriorating financial position of consumers. That's possibly at the lower end of the market, but at the middle income end, it's not too bad. And what is going to help is the fact that there are signs that the upward trend of interest rates that we have seen in the last year is virtually coming to an end. Inflation starting to decline. And there are hopes that possibly even before the end of this year, we may see interest rates starting to decline once more. Where does that put us in terms of forecasting economic growth? We're looking at a healthy plus 0.4% for this year. Sorry, I'm being a bit cynical. Rising a little to 1.5% next year and the year thereafter. And that's more optimistic than many other forecasts. And the reason is simply that we're saying just a fraction of all these infrastructural investment programs will indeed start seeing the light of day over the next couple of years, especially the move and acceleration in the move to try and adopt more capital intensive go into renewable energy and ensure that we have more private sector driven electricity availability. Private consumption expenditure, very low growth, not negative, but low. So it's really not a terribly exciting environment on the face of it, but there are plenty of opportunities. There are huge gaps that have being generated at the moment by the weakness of the economy. Another headwind that we're starting to face is that the trade balance. I mentioned how well our exports have been doing, but that's starting to lose ground as the world economy slows and mineral prices are starting to decline again. And of course, you know, many of the profits that are being derived in South Africa are being driven by foreign companies, and that has resulted in, especially on the mineral side and the big profits that they've been making, they've been sending out a lot of that money as dividends to their shareholders. So we have seen a significant deterioration in the last couple of months in the current account, and we've moved from a nice surplus for the first time in many years back to a deficit. And that's, of course, one of the factors weighing on the rand at the moment. Now, key to the outlook in many ways is what's going to happen to the world economy. And especially in South Africa's case, we are dependent on commodity prices, as I've shown, and we're seeing a fairly mixed picture. From the from the early part of last year, following the invasion of Ukraine by Russia, we suddenly started seeing prospects for the world economy deteriorating. And that coincided with the desire of the world's central banks to raise interest rates to quell inflationary pressures. And in response to that, we saw a decline in all sorts of commodity prices. But then late last year, there was an additional headwind, and that was that China had locked down to fight coronavirus. Very heavy lockdown that caused Chinese economic growth to plummet to 3%, a level that it hadn't seen in almost 40 years. And then suddenly, late last year, Xi Jinping decided to start lifting, after protests, to lift lockdown restrictions. And we have seen some revival in some key commodity prices, such as iron ore and some of our metals and precious metals. But On the other side, there's been a collapse in energy prices. Now, which way is the world economy going to go? And it's not quite certain. And I've just got this updated chart this morning, and I looked and I could hardly believe it, but because coal is not traded on a daily basis on our markets, but this is an update of what has happened, Richards Bay, and we see that the massive boom that we had in coal prices has faded quite dramatically, probably in line with natural gas prices and the price of oil that has fallen back more recently. And so that is a negative for our economic outlook, unfortunately, because one area in which it's going to impact negatively if we don't export too much and generate the profits is on our fiscus. If you look at the medium-term budget policy statement in October, they said, hey guys, we've collected 84 billion rand more in tax revenue than we had anticipated in February last year. And that's a wonderful way in which to be able to fund, for example, the extension of the special social grant to unemployed people, about 10 million, that 350 rand a month, and also to grant a little bit of leeway to provide slightly higher wages to public servants to avoid too much industrial action. And we've escaped that one quite nicely. You can see that 63 billion of that 84 billion is through improved company taxes, especially your coal mines that have been generating huge profits. Now, that has in turn worked through to enable us to reduce our budget deficit compared with where we thought the budget deficit would end up a year or two ago when we were doing our projections. It's looking much better now, much smaller deficit. And the public debt to GDP ratio now looks like it may be peaking at a level of around 70% instead of the 80 or 90% that we were headed for before. But that all depends on whether we can continue relying on these improved commodity prices. And I showed you there this shock I got this morning about the collapse in coal prices. I still want to look into that a little more in a little more depth to see how valid it is and realistic, because that will change the scenario. And one of the advantages of this revenue bonanza that we've had is that it has solidified our credit ratings. Not that our credit rating history is particularly attractive. You can see another factor. I showed you how South Africa's economy started underperforming from around 2012 onwards. It's no coincidence that that is exactly the time that our credit rating started being revised downwards from investment grade and more recently down to just the revenue benefit that we received over the last year has enabled those ratings agencies to put us on a more stable footing, and we have been able to avoid further credit ratings downgrades. In fact, S&P Global has put us on a positive rating, which means they were starting to look at even improving our credit rating back upwards again soon. But nonetheless, what it has meant is that the relative improvement in our fiscal situation has enabled our longer term interest rates to start coming down a bit. And the advantage of that is, of course, that the debt servicing costs of government have actually fallen in line with that. Nonetheless, as much as, you look at these figures, you still pay a 10-year view in South Africa, and 8% to borrow that money on a 3-year view. That is very high in relation to our inflation rate of 6 to 7%. And you can see our real long-term interest rates in South Africa are amongst the highest in the world. And this weighs down heavily on the government's ability to spend on uplifting, on upliftment and service delivery. And this all stems from the very poor economic growth that we have been achieving, which is not generating enough tax revenue to fund the expenditure that we would like. Fortunately, we've got a national treasury that seems to recognize that and is trying to spend, stick to its budgets and stay within its means. Now, talking about risks, the obvious big one is what's going to happen to the global economy. And the 2022 saw a massive reversal in the fortunes of financial markets. You can see, for example, the US S&P 500 index had quintupled between 2008, the crash then, to a peak towards the end of last year, towards the end of 2021. Suddenly in 2022, it suffered its biggest downturn in a long, long while. Well, actually, I see the COVID-19 downturn in April 2020 was almost as bad. More recently, there's been a little bit of a recovery back again in this, but the fact is people have suddenly started being, or over the past year, have started getting very wary of financial asset prices. And no wonder they have, because what's actually gone hand in hand with the jitters on financial markets is the fact that the massive injection of liquidity into global financial institutions through quantitative easing, firstly to get us out of the mess of 2008, and then secondly to get us out of the mess of 2020 with COVID-19. This massive liquidity was what had been driving all financial prices upwards. And suddenly inflation started rearing its head, and the central banks of the world had to turn around and start tightening. And you can see how this graph has turned around more recently, and the growth in money supply has diminished. So there is a threat of a diminution of the liquidity necessary to drive these commodity prices, to drive these financial asset prices ever higher, and they've taken a big knock. On the positive side, the most recent evidence is that inflation around the world is starting to come off the boil. In Europe, it's come down from 10.5% to 8.5%, in America from 9 to 6.5%, and in South Africa from 7.8, the latest figure 7.2%, but it's going to carry on falling in coming months. And so what we have seen is, this is America, the Federal Reserve Board's governors seeing a massive increase in short-term interest rates from 0 to over 5%, and then likely to come back down again through 2024. More recently, you've seen other central banks like the European Central Bank joining the fray, the Bank of England also joining the fray, but these are significant headwinds against economic growth. The other side of the coin globally was this massive fiscal stimulus. I mean, American government was paying people sending them a check of $1,000 every month for 4 months to try and make them survive through COVID. The result has been, like in America, that most of your leading governments or governments of leading economies have seen a surge in government debt to GDP, to unprecedented levels, record levels. Now, the problem with this is that should the world economy slow down too sharply, then these governments will no longer have the ammunition to pump still more money to keep the show on the road. And that is one of the big threats. But the lagged effects of all the stimulus that we had are manifesting themselves in unexpected strength in the US economy most recently, despite higher interest rates. And we had on Friday the news of 517,000 new jobs being created in the US economy in January. That's an increase of 0.5% in the workforce in 1 month. The unemployment rate fell to its lowest level since Lyndon Johnson's presidency in the 1960s. And despite that, we see that the growth in wages has slowed down from 6% to 4.4%, which is, so people have kind of got mixed views about, will we need to keep interest rates around the world high for longer? Are we going to see unexpected strength in the world economy that will require that to quell inflationary pressures? Or are we going to suddenly see a fairly dramatic slowdown in global economic activity? And this is what the world is grappling with at the moment. And we've seen massive switches in sentiment from one day to the next. Last week, people were quite upbeat that interest rates would start coming down around the world before the end of the year. And then the US government announced these massive increases in employment and drop in unemployment. And people said, hey, this economy is still motoring at a hell of a pace, which means interest rates will have to remain higher for longer. And suddenly the dollar revived, the rand collapsed from 17 to 1760, and the stock markets had taken a knock once more. And there is one thing that's at the back of people's mind that's worrying them a lot, so-called yield curve. In America, if you look at the trend of short-term 2-year interest rates in red and 10-year interest rates in black, you can see how the trend of 2-year interest rates has shot up way above the 10-year interest rates, so-called inversion of the yield curve. This has traditionally been seen as a classic warning sign of an impending recession, and it hasn't been as inverted since 1980. And so on the other side, people are saying, but we can't keep interest rates too high for too long because we're going to plunge the world economy into a recession. And then, but on the other side, we're seeing right now, the American economy is still pumping. So this is the dilemma. And you can see it in terms of the huge volatility in exchange rates. Last year saw the dollar rising by some 25% in value against all currencies. And then as people started saying, hey, interest rates can't carry on rising, they've got to start coming down or we'll have recession, the dollar has come tumbling down by about 10% since then. And that's, of course, influenced the rand's movements quite significantly as well. Nonetheless, you can see the rand has weakened a lot in the last 3 years. Since the middle of 2021, we were at 13.5 rand to the dollar. Today, we're at 17.5 rand to the dollar, partly because of dollar strength, but also because, in part, the rand itself is weak. If you look at the rand's value against a basket of currencies and adjust for inflationary pressures, the rand is back to close to the lows that we've ever seen, other than 2001. That was a freak. But, you know, the rand is extremely cheap. But there are fundamental reasons why. Load shedding and weak economic growth mean that tax revenues are likely to remain low. And so there's still the threat of an increase in government debt. Then there's another big factor that is on our minds this month specifically, and that is a potential grey listing of our financial sector. There's the Financial Asset Task Force globally that looks at countries to see what they are doing to fight money laundering. And South Africa has been accused of not doing enough. In recent months, they've tried to catch up and do whatever they could to reduce the chances of this grey listing, but it still remains a potential at the end of this month. And if we were to be grey listed, it would make financial transactions into and out of South Africa a lot more difficult. And then the final point is the slowdown in global economy. How steep is it going to be? And are we actually going to see a fall in commodity prices? And now this morning, I was alarmed to see how the price of coal, which has been holding up so well, might have suddenly plummeted more recently. So the rand is weak, but I don't see it improving dramatically. And you can see from these forecasts, we're looking at a currency of around 17.5 for this year to the dollar, 18.5 next year, 19 the year thereafter, 19.5 after that. And against the pound, 21.5 this year, 22.5, 23, 24 kind of thing. Obviously, critical assumption is what happens to the dollar itself, and we've suggested fairly stable dollar-euro exchange rate. On average, it'll stay more or less where it is right now, on average. But within that, you could see quite some significant ups and downs. The positive here in South Africa right now is that, like with many other countries, inflation is coming off the boil. You can see our producer price inflation rate has come tumbling down. This is because one of the elements that caused inflation to rise sharply around the world was the lagged effects of lockdowns. Suddenly there were all sorts of shortages in the supply of various inputs, and in particular motor parts, for example. That seems to have been easing off. Food prices is a big concern, especially with load shedding. Well, we were seeing food commodity prices coming down and hoping that food inflation would come down, but now we hear the load shedding is causing a lot of food producers in South Africa to hold off producing too much because they can't refrigerate it enough. So I don't know how rapidly that's going to come down. But on the positive side, the fuel inflation rate is coming down quite sharply and likely to continue coming down, ironically, even if fuel prices rise a bit more, because this time last year, they were surging ahead following the war in Ukraine. And so on a year-on-year basis, food inflation is not escalating that much. We don't know what's going to happen to electricity tariffs. Eskom has been awarded a 18.65% increase in April, but Ramaphosa has said, please hold off this, so we don't know what's going to happen there. But what is encouraging is forget food, forget fuel, forget electricity. The core inflation rate seems to have peaked at 5% and started coming down most recently. It's early days, but we feel fairly confident that inflation will gradually decline to a level of about 5.5% average this year. Already within the next month or two, you're going to see it coming down below 7% to 6.8, down to 6.5%. Average for the year, 5.5%, and carrying on falling through to around 4.5% by the middle of next year. And that should enhance the ability to get interest rates to start coming down before too long. That is the end of my presentation, and I'm happy to take questions if there's time.
Thank you very much, Dr. Azar, for your insights. There's been lots of comments on the chats and on the effects of everything that you have mentioned on the insurance industry, certain exclusions that have been put because of load shedding by the various insurance companies, and what brokers are seeing with their clients. If there's anybody that would like to ask a question, you're welcome to just put up your hand and I will unmute your mic. Justin, I'm not sure if you're still on the call. Do you have a few words for our brokers?
Yes, I do. And thank you very much for the most insightful talk and a really good way to start the year. So the first Tuesday of the year, so I would like to say welcome and thank you to all of our brokers who joined us. And maybe a few questions from me, potentially, maybe as a start. I mean, one of the areas of focus of I2 is in renewable energy. Dr. Demeen, I don't know if you have a view on the potential of renewable energy to solve some of the load shedding challenges that we have. Is it too little and too slow? What is the potential of renewable energy in the next few years in South Africa? And I know there have been delays in round 5 and 6, but do you have any views on the impact on the economy and the potential for wind and solar to solve some of our problems?
Certainly, from a longer term point of view, I do see a little bit of light, literally. there. And I do believe that the private sector can run with this and actually resolve a lot of our energy problems. But it's going to take a while. I don't see that resolving the load shedding problem for at least 2 years, if not quite a bit longer. But, you know, if you look 5-10 years hence, undoubtedly, I think renewable energy will be able to resolve many of these problems. Already, Cyril Ramaphosa has been talking about a potential to add 9,000 megawatts. Well, that's more than enough to stop all load shedding. But we're not going to see it coming on stream before another 2-3 years. What we also need to see is the bureaucrats within government starting to relax a bit in terms of allowing the private sector to get on with the show. They haven't been doing so. There is this antagonism within the government and private sector. No, you can't let them. We've got to have it all in control in our hands. And that is been holding back progress in allowing companies to develop their renewable energy projects. But some of them are just ignoring, going ahead and doing so. Some of your larger mining companies and so on, they're going ahead and doing so. Thank heavens for saving grace. Yeah.
Good, thank you. So some positive in a lot of the doom and gloom that you shared. Maybe a last question from me, and then I'd love to hear from some of our brokers. But what advice would you give to South Africans? So like me, I'm sure most of our listeners here are South Africans and based here and have kids here, and this is where we work and have businesses. What's the opportunity and what's the hope for the private sector and for all of us? Do you have any advice for small businesses? What should we be doing?
I think small businesses in South Africa, well, business in South Africa has traditionally been very enterprising. And I think that there are plenty of opportunities. You can see that rather than looking at all these constraints, one can start looking at solutions to these constraints, and therein lie the opportunities to actually finding gaps that can actually resolve a lot of these problems. Renewable energy is just one such example. There are many, adopting IT systems
finished here.
overcome. And I think we are seeing a lot of it. And that's why, with all that we are facing in terms of poor governance and incompetence and inefficiencies, the South African economy has still not collapsed. And there is a reason for that. And that is because other parts of the economy, people are still going about finding opportunities and doing their business. And I would say that if you're enterprising, this is still a great country to actually try and be successful. And it doesn't have a lot of the theoretically, the day-to-day bureaucratic constraints that so many other countries have.
Well, that's a really good positive note for me to end on, and to all of our brokers and clients out there, and even our 2 team members. There's opportunity in all of these challenges that we face. And I think one of the things that makes South Africans so special is our ability to deal with these challenges. Are there any questions from any of our brokers before we wrap up? So any other questions before we wrap up?
No questions that I can see on the chat, Justin. It's just comments thanking Dr. Azar for a very informative session.
Okay, well then let's end it there. So Dr. Azar, thank you so much. Really great to hear from you. Thank you for your insights. And let's end on a positive note and go out and make it happen this year and look for those solutions and opportunities amidst all the challenges. Thank you very much. The first Tuesday of 2023. And we look forward to seeing you at the next one, same time next Tuesday.
Thank you, guys. Thank you, everybody.
Thank you so much.
Thanks,
Thank
Dr.
you.
Azar.
Thanks for the opportunity.
Bye, guys.
Bye.